We are live now.
Anvisha, Romanu, should we get started?
Hello, everybody. Good evening. Welcome to the session. Today, we have the third session of the AI and risk mitigation series. And today, we have with us Rachna Maheshwari, who's the Associate Director at CRISIL, and she'll be discussing trading and she'll be discussing AI technologies within trading and financial capital markets. And let's get started. Over to you, Rachna.
Thank you, Romanu. To get started, today we're going to be discussing applications of machine learning algorithms in capital markets. Now, this includes several different aspects of capital markets, and this list is not comprehensive. So what I'm going to do is, in the discussion today, I'm going to provide an overview of machine learning in capital markets. Then I'm going to discuss some use cases in trading and investment, specifically focusing on returns forecasting and on how machine learning can be used in trading algorithms. I will also discuss some use cases in asset management, particularly looking at the problem of mutual fund manager selection, mutual fund selection, if anybody is making investment decisions, and also how weights are optimized. So there'll be like a really small illustrative example on how assets are classified or clustered to determine how much weightage should be given to each asset class within a portfolio. And then finally, I will walk through a list of caveats and risk considerations. So ML has applications in portfolio management and trading, as I just mentioned in the introduction. Some specific examples where machine learning can be used are forecasting of asset returns. So traditionally, regression models and statistical time series models have been used for returns forecasting. But lately, we've noticed that machine learning algorithms such as neural networks do very well in returns forecasting. So this is one application of machine learning. The second application is selection of funds and fund managers. Machine learning algorithms can be used along with data on fund characteristics, fund manager characteristics, and characteristics of the composition of assets within a fund. All of this data can be used within an algorithm to forecast the returns of a fund. And that can be used to determine both which are the funds that are going to perform best and also which managers, when paired up with certain kind of funds, are likely to produce the best fund outcomes. The next one is asset allocation. So one of the very big problems in capital markets and asset management is the optimal allocation of funds across different asset classes. And again, here, machine learning algorithms can be used to determine the weights that should be assigned to various different asset classes within a given fund, given the objectives of the fund. So there are funds that are aggressive. There are funds that are, it's predetermined that they are passive funds. And so given the objective of the fund, weights can be assigned across different asset classes. The next is trading strategies. And this is sort of a use case that, it's very topical at this time and is being discussed very widely. And so what is essentially done here is machine learning algorithms, in particularly the more complex machine learning algorithms such as reinforcement learning, which do very well with historical time series data, are used on historical high frequency data on trades for any particular stock, and such data is publicly available from certain sources. So this is normally called limit order book data. And the data points that are available are, number of buy orders, number of sell orders at a given point of time, the bid-ask spread, the market prices, the historical volatilities. This is all of the market data that is available. And then for a particular fund or a particular trader, historical returns would also be available. And other sort of data attributes, based on his trading approach or style would also be available. And so given this historical time series data, one attempts to use reinforcement learning to sort of determine how, outward forecasts can be done for what the optimal strategies should be. And also to inform trading strategies, right? So essentially, when a certain kind of market environment is observed, uh, uh, you know, um, should we be like, given that market environment, is the appropriate approach to buy or to sell, or to sort of execute a certain kind of trade? These are the kind of questions that can be answered when machine learning algorithms such as reinforcement learning are used for informing trading strategies. So this is over and above the expertise of traders. You use algorithms and outcomes of the algorithms to inform the trades. Um, the next is trading algorithms. So trading algorithms within themselves use what we call a jargon, but what is called symbolic AI, which is basically just a bunch of if and but conditions. But over and above that, statistical AI can be used within trading algorithms. And I will just demo, a small bit of code on this. This is another use case. Then there's execution of trades, and I'm going to delve into this in a little bit more detail as we go further. And the idea here is, so there's a particular infrastructure environment that is in place for execution of trades. So if a buy order is placed, there should be a sell order to which it can be matched. And the whole idea is that this matching process can take some time between the buy and the sell orders. And what we've historically had in place is the whole process is static. So, there's a wait time, and even though it's very, very short, it could be like 10 milliseconds in certain exchanges, like the New York-based exchanges, the New York Stock Exchange, 10 millisecond was the static wait time for a buy and a sell order to get matched. And NASDAQ in September 2023 got approval from the Securities and Exchange Commission to put in place a reinforcement learning-based dynamic order execution mechanism, such that the 10 millisecond time is reduced. So given, again, the way it works is, since it's reinforcement learning, it learns from historical past data. And, given that essentially, when certain trades are placed, given a whole set of sort of a background variables, it reduces the 10 millisecond execution time to a lot shorter, right? And so that's the whole idea. And this is now it's a sort of specific type of exchange order with reinforcement learning embedded in it, and they've patented it. So NASDAQ has patented this. So it's quite an interesting development. The next sort of area in which algorithms are used is market making. And so by market making, what we really mean is the whole activity of market making, which is done by banks and other such large institutions to facilitate liquidity in the market. So there could be a large number of buy orders, but there may not be a substantial number of sell orders. And so market makers would, or sometimes the bid-ask spreads are too large, and they're large when the buy orders are very voluminous and there aren't enough sell orders. And so market makers would come in and make midpoint sort of bids to facilitate execution of trades and also to reduce the spreads. And they also make margins in this because essentially they're earning just from the arbitrage, right? There's an opportunity whenever the bid-ask spreads are too large or too wide. And so this kind of market making activity, again, as is very obvious, um, algorithms can be used to detect lucrative market making opportunities in an sort of on a sort of trading platform, as well as for uh, you know um, uh, sort of triggering the right kind of orders to facilitate liquidity in the market. Okay? And the last is sentiment analysis. This is, again, being done very widely. And this involves NLP and sort of the idea is web scraping of large volumes of data, including news data, as well as other data that would be available on the World Wide Web, and using such data to conduct sentiment analysis, right? So that's primarily what's done. And sentiment analysis, there are several vendor providers who actually provide sentiment analysis on a whole list of stock tickers, right, on an ongoing dynamic basis. So you get sort of dynamic data feeds on market sentiment for a particular any list of stock tickers that you give them as a trading entity. They give you dynamic feeds on what's the market sentiment for those set of stock tickers based on all the sort of web scraped data that they have, which they glean off of the web and off of various different news sites. And they use natural language processing to process this data and then to come up with sort of sentiment signals for a particular stock, or of course a whole list of tickers that you share with them, right? So there are specific startup firms that are vendor sentiment analysis data providers, and that work in this area. So this is like a whole set of it was my sort of goal here to provide an overview, and it's really not a comprehensive listing. There are other ways in which machine learning algorithms are also used. For example, large banks execute orders on behalf of their clients. And one of the challenges they have is they could have institutional clients who place really large orders, right? So there could be an institutional client that wants to pick up 20,000 stocks of Larsen and Toubro. Now, if you were to go into the market and execute a trade and bid directly for 20,000 stocks, you could imagine that the prices would go up, right? Because it's a large volume of stocks. Maybe not 20, but it could also be like a number much bigger than 20, which is a substantial percentage of the volume of the stocks of a particular ticker that are in circulation in the market. In those instances, what banks do is they stagger the trades. And by staggering, what I mean is they're not going to go and bid for 20,000 all in one shot, but they're going to strategically stagger it over time so that the execution of this trade doesn't cause the prices to go up. Else they would just end up making not a very lucrative trade for their client because the prices of the stock are going to be too high. So this is again something for which reinforcement learning is being used to sort of facilitate staggering of trading orders given the current market environment. And again, the reinforcement learning algorithm here learns based on historical instances of staggered orders. and informs the traders given the current market variables. So what's the best way for them to stagger the trades across different, over time and in lots, right? So how many lots should they be bidding for at a particular point of time? And then what should be their waiting time? So this is another use case. So these are all sort of different use cases that I've gone over. My goal here was to sort of provide an overview, but again, I don't think I've done what I've discussed is a comprehensive coverage. Nonetheless, I think I've covered most aspects of capital markets in which machine learning at this time is being used. Okay. So at this point, I'm just going to pause and quickly ask if there are any questions. Else, I'm just going to go on to discuss a few use cases very quickly, and then finally talk about the risks associated with machine learning in capital markets. So are there any questions or comments or thoughts?
Yeah, hi. Rachna, we have a couple of questions from YouTube.
Yeah.
So Ravi Kiran asks, with complex trading algorithms, can anyone get 100% success in trading?
Uh, I wouldn't say that complex algorithms ensure 100% success in trading, right? But what they do is I do believe the chances of reducing losses and you know running your trading business more lucratively, the probability will increase definitely if you're using algorithms to inform your trading decisions. I mean, if you're using machine learning, because essentially what it does is the technical analysis that you do manually, think of taking that data and feeding it into a machine learning algorithm and getting the algorithm to detect all the patterns and helping, and then the algorithm outcomes help you in making informed trade decisions. So if it's executed appropriately, trading can definitely be more lucrative, and the probability of loss could be lower, or losses could be mitigated.
Okay. Thank you. We have some more questions over YouTube, and then I'll go to Sachin's question. So using ML algorithms, can we identify which companies are going to leaders in the respective sectors or bankrupt?
Which companies are going to?
Sorry, I think there's some typo over there. I'll move to the next question. So Sachin's question is, could you please also speak briefly about regulators' position on these use cases? For example, is the regulator taking ML use in a positive way, or are they seeing it with skepticism?
Okay, so towards the end of this presentation, I'm going to talk about regulatory and governance risks, where I'm going to cover not just the specific regulations at this time, uh, but I'm going to talk about the risks that regulatory agencies globally have identified with the use of machine learning. So that's going to be covered in the presentation.
Okay, that's all the questions we have. You can go ahead.
Okay, great. Thank you. So moving on, so this is the first use case that I wanted to talk about. So here what we're talking about is how machine learning can be used in trading algorithms. Now, we would all know that in very simple terms, algorithms are nothing but really a bunch of if and but conditions, right? So if certain conditions are met in the market, uh, execute a buy order. If certain other set of conditions are met, execute a sell order, go short, go long. That is what an algorithm does. Such algorithms that do not use data, but are just, a bunch of if and but conditions, are actually, like, a lot of folks would say this is not artificial intelligence, this is not machine learning. But the truth is, anywhere where you use a bunch of if and but conditions to define an algorithm, it falls under broadly artificial intelligence. That can also be used sort of in AI applications, right? And we call it symbolic AI. Now, the difference is symbolic AI would just be, as I said, if uh, uh, the price of a stock increases by say 10%, and your target was 7% increase, and you're going to sell, then you will write a little, just a line of code and say, if the price has increased above 7%, my target price is met, so execute a sell, right? That's symbolic AI. Moving on, what is statistical AI? So statistical AI is what we're talking about over here. And these are situations where you have algorithms that are trained on large volumes of data, which is the kind of artificial intelligence and machine learning that we are interested in. Now, these can be used in two ways in trading algorithms, right? So there's implicit and explicit use. Implicit use is when you use statistical AI outside of your actual algorithm. So you've got an algorithm, a bunch of if and but conditions for trading. You use statistical AI outside of that to make predictions about prices of, say, a stock, right? And what's the stock price going to be in the next 10 minutes, in the next 1 hour? And you can literally do like even second by second predictions, right? Using high frequency data. And then if your prediction says that the stock price is going to increase or decrease by a certain percentage, accordingly, you can make decisions about what your trades are going to be going out in the future, 10 minutes from now or 1 hour from now or early tomorrow morning, because you can also do, if you're using daily data, then your predictions are going to be about tomorrow's price, right? Is the price going to increase or decrease tomorrow? But if you're using high frequency data, which is literally all, second by second getting recorded, then you're going to be making predictions a few minutes ahead, right? So you could run your algorithm, you could run your machine learning algorithms for making these predictions outside of your trading algorithm, get the outcomes of the machine learning algorithm, and then update your trading algorithm accordingly. This has some problems, as you would see. This is actually more widely used at this time, but this has some problems because it slows down the whole process, right? So you run the machine learning algorithm outside, then you get an outcome from it, which then is used to update the trading algorithm. It's a slow process, and there are going to be time lags in the middle. And this is a world in which that just doesn't work very well. So the other alternative is explicit use of artificial intelligence, where your algorithm is embedded within your machine learning algorithm is embedded within your trading algorithm, right? And I'm going to show you a very simple example of that. I have the Python code, but after you see the simple example, you could probably sort of work on more complex examples as well. So here, what algorithms are used very widely are the classical linear regression and its variations, such as linear regressions, penalized linear regression, the lasso regressions, um, um, regressions with measurement error correction, because financial data has measurement errors. It's very noisy. So all of those variations have been used, continue to be used. This is usually the first step. So you'll start with the linear regression, move to more complex algorithms, which probably, hopefully, are going to give you better outcomes. And then you'll say, okay, I'll choose the neural network in favor of the linear regression. So first step is always the linear regression. Decision trees are used, and then neural networks. So empirically, the studies that have been done have demonstrated that neural networks give the best outcomes at this time. And, several different variations are being used. So artificial neural networks, convolutional neural networks are being used. Long short-term memory networks are being used. Multi-layered perceptron is being used, right? So these are all giving better outcomes than the sort of, traditional classical statistical and machine learning methods. The input data that is used is trading data. So there would be returns and volatility. This data would be available from the trading desks. There would also be, historically trading volumes that have been sort of traded at particular desk. All of that information will be there. Then there's high frequency limit order book data. So limit order book data is publicly available, very commonly used for even building out these algorithms by anybody who wants to just sit down and code algorithms. I was doing some of that yesterday and today morning. I've been working on this. And what this is over here you have buy and sell orders. You have the bid-ask spreads, and it's high frequency, so it's recorded at very small time intervals. You have the trading volumes daily. You, of course, have the open, the close, and the average price daily. You have volatility, because when you have prices, of course, you can calculate returns and volatility using the prices, right? So all of this data is available. And there's a public source. There's lobsterdata.com. You can actually go to this website, download some of this data for certain stock tickers, and use it to train an algorithm. And, it's really easy to do in Python. Then fundamentals data is used. It's a little bit more difficult to gather and get. So if there is a certain set of tickers that an asset manager is trading in, he would have, for that set of companies, he would have accounting data, management data, and sentiment data. Sentiment data probably obtained from an external vendor. All of this together makes up the fundamentals data. And then there's macroeconomic and financial indicators data, which is again publicly available and used in these algorithms, right? So these are all the different data sources that are used. What I have seen very widely, what's being used is the trading data, limit order book data, and fundamentals data are being very widely used. In situations where an algorithm has been trained and has been published in a book, in a paper or a book, or is available in open source, usually it's limit order book data that is used, because getting fundamentals data can be, some of it can be proprietary, and some of it can be costly. Sentiment data has to be obtained for a price. So if you're obtaining costly proprietary sentiment data on a set of stocks, and you're training your algorithm on that, you're not going to make it open source, right? So in the open source environment, usually what you see is macro and limit order book data is used, because this is publicly available. Internal trading data and fundamentals data is not used very commonly. So that's about all of the input data that goes in. And the conclusion is something that I've already mentioned, that neural networks and deep learning models are outperforming classical statistical and machine learning methods in trading algorithm applications and returns forecasting, right? So this is just an empirical observation based on the papers that I have gone through very recently, and the applications, open source applications that I have seen. And also some work that I'm seeing with some of my clients. Though they're also a little bit anxious about using deep learning because there are explainability challenges, which I'll get into later. So here, what I'm looking at is just a bit of code. PyBroker is a library that somebody created for the purpose of machine learning based sort of trading activities, right? And you can obtain it. You can just do pip install lib PyBroker, and you can install this library. This is just a simple Jupyter notebook that I have opened up. And what it does is it pulls up data. So it's hooked up with Yahoo Finance, and it pulls up data on any list of sort of stock tickers that you give to this algorithm, right? So here, the first thing that is done is a function is defined for, this is just creating moving averages of returns or prices, whatever the input variable is that you want to use. So, and we're going to use this function later on. So you're going to see why I wanted to create a function for, just sort of calculating moving averages. And here, what I'm doing in the next step is I'm just defining the look back period. So the data that I'm going to use is daily data, and my look back is 20 days. So it's going to create a moving average of 20 days. You could change this variable, make it 30, 60, whatever, or even annual. But that's something that can be varied depending on what works well for your model. What I've done is a very simple problem. As I said, I'm starting with a linear regression. I would recommend everybody start with a linear regression, and then you can move on to more complex algorithms. So here, it's a simple linear regression. And as you can see, what I've done is I've trained this. So I'm doing the train test split over here. So this is my train data. This is my test data. And I'm taking the previous day's close here, and then I'm just calculating daily returns. And the variable that I'm going to predict, my outcome variable, is basically just daily returns, and I'm shifting it back by 1 day. So I just want to take the lag value of daily returns. That's the outcome that I'm going to attempt to predict. And the explanatory variable that I'm using is that I created. You could again create the moving average of closing prices. You could create the moving average of any other variables, or you could use other predictor or explanatory variables. So that's my X variable here. I've just created the moving average of closing prices. That's all I have done. And I'm just going to attempt to fit a very simple linear model. The goal is to predict the price for the next day. And so I've done my train test split over here. And here you can see that basically I'm implementing trading rules that generate buy and sell signals from the model that I created, right? So I have this model in place. So I've created this function within PyBroker. And this is my training input. And then I'm going to implement trading rules and generate buy-sell orders. So now what I've done, once I've created all of these functions, I'm going to just create a strategy object and take the training model and our trading rules, and I'm going to implement on 2 new stock tickers. So these are different from the tickers that I trained the model on. So but I've created the functions. So I'm just taking NVIDIA and AMD, both technology companies. I'm sure you've heard of them. And I'm just pulling out the data from Yahoo Finance, and I am just doing, training the same model and sort of implementing the model that I created above with the train tests split. So these are just a bunch of steps for back testing. And here, so the strategy walk forward is an embedded function which is available within PyBroker. What it does is, because this is time series data and recency is important, so essentially it's going to, if you were to run the same algorithm on a daily basis or a weekly basis, it's going to update the data and update the dates of your training and testing data. So essentially, 1/3 of the most recent observations are retained as test, and the 2/3 just before that are your training data. So that's the train test split that I am using, but you could use something different. It's your choice, totally. So now what you see here is, this is a whole bunch of results metrics that we receive from the algorithm itself. This is also a function embedded within the algorithm. And it gives you all of these metrics. And so you're getting, I've sort of, I'm looking at the 20 days period. That's the period that I've defined. And I'm getting a whole bunch of metrics for these 20 days. So total number of trades that are done, the initial market value, the end market value, the total PNL, the unrealized PNL. This is again just an embedded function, which I did not create. It was available in PyBroker. I just used it and I generated these metrics. And I've just done some, again, bootstrapping and creating confidence intervals for my profit factor and my Sharpe ratio, which are important metrics for me. Right? So it's a very simple example And you can take this framework, and instead of the linear regression, you could embed a neural network, you could embed any other. It's like a good platform for trying 2, 3 different types of algorithms to see which one performs the best. Yeah. So that was just a quick example I wanted to go over. So with this, I come to the close of the first use case. And in this example, what you see is this is an example of explicit use of the algorithm because I train the algorithm here and I generate the buy and the sell orders. Now, in an ideal world, this would be hooked up to an API, which would be hooked up to a trading platform. And my buy and my sell orders that are being generated here with this if and else condition would get executed on the platform. And again, such trading platforms are available, and you could go in and create an account, and they have sort of a Python coding interface. So you can code, and there's an API, and it hooks you up to the trading platform, and you can just define conditions like this, and the trades get executed. Yeah. So this is an example of explicit use of machine learning, where I use the algorithm to forecast the price next day. And based on the forecasts that I'm getting, I am executing trades over here. So making the decision to go long or go short. Yeah. Okay. So this is sort of what I wanted to discuss in trading algorithms. Now, moving forward to the next use case. This is a very interesting use case, and it's a little bit more sort of it's just it applies to a different world because it applies to the world of fund managers. We could look at exchange traded funds. There could be mutual fund managers, and it looks at the world of funds. And the idea here is you look at the returns or the returns above the risk-free rate and alpha and beta that are historically being generated by a bunch of funds. And then using the characteristics of the stocks that comprise the funds and the overall fund characteristics, and using all of this data within a neural network, you attempt to forecast the returns of the funds. And once you've attempted to forecast the returns and you have a model that predicts returns very well, based on your returns forecast for the next 1 year, you classify the funds into different deciles, right? And this is a really good way for you to select a set of funds that you would want to invest in, because obviously all of us would want to invest in the top decile, right? Research has been done on this, and it looks like it's really possible based on the outcomes to sort of, in markets where a large number of mutual funds or ETFs operate, it is possible to sort of observe the differentiation in returns forecast for different funds and choose the best funds. On the similar lines, you wouldn't just also choose the funds that are in the top 10 decile based on your returns forecast for the next 3 quarters. You would also want to, choose those fund managers, right? So those fund managers would be like sort of, ideal folks for you to work with if you were somebody who was looking to hire a fund manager, for example, right? Or if you were somebody who's producing industry ratings of fund managers, because that's something that's really important, particularly for institutional investors, because they're very aware of the fact that different fund managers have different asset management styles. And they have their own subjective way of doing asset management. And, it's important to evaluate these fund managers over and above just looking at the alpha that a fund is generating, right? So this is, again, a really good use case and an example of machine learning. And again, regressions, decision trees, neural networks all have been tried. For these kind of purposes, neural networks work the best here. So this was another, use case that I wanted to discuss. Here I have like an example of a neural network. So it's really simple. What you see is your input data is macroeconomic variables, and fund characteristics. But besides these fund characteristics, you can also have, as I mentioned earlier, um, characteristics of the stock holding company. So these are fundamentals, basically. So your returns and profitability measures of companies, intangibles, value measures, trading volumes of a particular stock ticker. These are all of this together. This represent the fundamentals of the companies that you carry within your portfolio. And so you could use stock characteristics, fund characteristics, and macroeconomic variables. All of this is inputs. And here you would have what they have is a very simple neural network. They have a hidden layer. They just use a, a rectified linear unit activation function over here. And then they produce these hidden layer outcomes. And then this is just a function. The final output is just a function of all of the of sort of outcomes that are observed at the various nodes in the hidden layer, right? So this is really just, I would say it's an MLP, like there's just one hidden layer over here, and there aren't sort of multiple hidden layers. But and with this, they get really good outcomes. So this is the simple neural network that they're using, but you could, of course, um, try to increase complexity and see if creating multiple hidden layers gives you better fit, etc. Right? Given, of course, the constraints on the kind of data that you have and the number of observations, data points that you have. So this is a use case I wanted to go over. And finally, what I have here is a very, very nice use of unsupervised learning. So the algorithm that has been used here is hierarchical clustering analysis. It's a very simple and intuitive technique. It's the formula is called Ward's minimum variance method. And all you do is the each here the different the different inputs that you have, as you can see, are different asset classes. So you've got gold, commodities, oil. So gold, agriculture, oil, copper, and then you have the various indices. So there's S&P 500, Euro stocks. You also have various bonds of different duration and from different geographical regions, etc. Right? And the idea was this particular asset manager just wanted to cluster the assets based on asset type and the nature of returns. But there could, of course, be more complex usage, right? So you could take something like this and apply it to a portfolio of equities, and based on historical time series of returns and trading volumes and volatility of equities, you could attempt to cluster the equities into different slots, right? And the approach is very simple, very intuitive. It's just just taking the Euclidean distance between the different variables that are observed for each particular asset class. And simply the variables one could, use are your returns, your volatility, measures of volatility, and liquidity measures if they are available, right? Just with these three inputs, it's possible to create clusters and classifications of assets. And all of these three, returns, volatility, and liquidity of the asset, are very important determinants of trading strategies that are applied for different assets, right? And so once this kind of clustering is done, then an asset manager knows that he's got these asset classes that are in different pools, and he has to apply different strategies to each of the asset classes. And of course, most asset managers, investment managers are sort of sensible enough to know that if they see something that's like totally intuitively not making sense, right? So, for example, if S&P 500 were somehow, for some reason, showed up along with gold, agricultural commodities, oil, and copper, you would immediately know that it shouldn't be there, right? But generally, if the algorithm is applied properly, you would not get such unintuitive classifications, even with a set of very simple input variables, namely, again, returns, volatility, and measures of liquidity of any asset, right? Liquidity is availability for trading in simple terms, right? So this is again sort of another use case, which is very neat, very simple. You can obtain all of this data from Yahoo Finance and attempt to run this algorithm on Jupyter Notebook. And it's like a really clean application. So these are a few applications or use cases that I wanted to quickly discuss. And over to the most interesting part, because here I know that there's interest in talking about the caveats and risk considerations associated with use of machine learning, which is also something that's very important for me because I work in the area of risk management and specifically model risk management, right? And all of these algorithms are models. So risks associated with the use of algorithms in machine learning can be broadly classified into three categories. So there are risks associated with the model or the algorithm, its design. There are risks associated with data. And finally, there are governance and regulatory risks, right? So looking at model and algorithm, I think one of the most important issues with the use of complex models is a lot of these models are not inherently interpretable. Any investment manager, trader, or asset manager would have several different stakeholders to whom he would have to explain his decision, particularly if any of his decisions ended up in losses. Explainability of complex algorithms can be a real challenge, particularly when you take really complex algorithms and embed them within the trading that's happening in the trading platform. The algorithms run really fast and trades get executed very, very quickly based on algorithm outcomes. But if in case, for some reason, the algorithm is not performing well, there could be a situation where trades get executed, which should not be executed. Right? So, and then you would have to explain what aspect of the algorithm is causing this to happen. And this can be very difficult when reinforcement learning is used. LSTM is being used, convolutional neural networks are being used. Local and global explanations can be very difficult to produce. The next is algorithm testing. So if you were to embed machine learning into live algorithms, you would want to create a testing environment before implementing that live. You would want it to be tested in an environment which is very similar to, sort of very similar to a live sort of trading platform. Yeah, and that's very difficult to do. So how do how do we create the right testing environments? It's not just enough to do a training, testing, validation split of the data. Ideally, before the algorithm goes live, it should be tested in an environment which is very similar to a live trading environment. And creating that kind of trading sort of testing environments can be a real challenge. Implementation and automation of these algorithms. So if you come to think of it, we've been very conveniently doing little examples and just dealing with one or two or three stock tickers. A trader at a particular trading desk has a whole list of tickers that he's trading in. And you would have to implement these automated machine learning algorithms for a large number of tickers. And that's quite a challenging sort of thing to do. Overfitting and model complexity. So there's a really big problem with financial data and we all know this, that it's sort of high noise, right? So financial markets data is very noisy. If we complex models do better, but invariably they overfit. And then one has to deal with the problem of having a model that overfits in your training data, doesn't work so well in the test environment, which is a very common problem that we deal with. And of course, we've got regularization techniques, and you sort of put caps on weights or sort of penalize the parameters using regularization techniques. You can do hyperparameter tuning. But nonetheless, this challenge kind of exists, right? So there are solutions, but this is a risk or a challenge that any modeler should be very cognizant of and aware of. Data quality and integrity. So you could have situations where, as I say, limit order book data is being used, macroeconomic variables data is being used. These are all historical time series. There could be data errors, there could be missing observations. So it's important to really ensure that you're using high quality and accurate data. Data dimensionality is a real challenge. And that's probably why I really like deep reinforcement learning algorithms because simply what they help us to do is deal with the dimensionality challenge, right? You've got those hidden layers which help in reducing the dimensions of the input data. But input data here can be very large because you have all of these. If you come to think of sort of the problem that I was discussing, so there were fund characteristics, and then there were characteristics of all the stocks that made up the funds. And then you could have macroeconomic data along with that. And then you could also have, like, if you were looking at that was more of an asset management problem. But if you were looking at, a sort of a trading algorithm, there's a sort of a large there could be a trading desk with a large number of tickers or large number of asset classes that traders dealing with. And that in itself is a very large number of dimensions, right? So for that many assets, if he's only looking at the limit order book data, he still has the historical bid-ask spread returns, um, several different functions of the returns with feature engineering. He has several different volatility measures. He has measures of volumes of trades that have been executed historically for those particular asset classes. And that's quite a lot of data to deal with, right? So data dimensionality is a problem. All of this data, particularly in the trading environment and limit order book data, is high frequency data. And implementation, so training of a model on high frequency data and then implementing it such that real-time decision making is done when high frequency data flow is constantly coming into the model and the model is getting sort of trained with updated data. These are really challenging problems technically and not very easy to deal with, both in terms of the data as well as the sort of implementation infrastructure. So all of these risks and challenges exist. And I know there was a question on regulations. So with regulations, firstly, it is challenging to establish a regulatory framework to detect breaches. Simply, again, because some of these algorithms can so quickly get so complex that, where it's breaching can be difficult. For example, I use reinforcement learning to learn on historical trading data for a particular stock. Now, historically, for example, something like spoofing maybe has been beneficial in the case of that particular stock. And there were a few traders I had who actually did spoofing. Spoofing, by the way, is unlawful. The idea behind spoofing is when a trader will uh, just punch in a large number of fake trades to misinform the markets and increase the market prices. And on the other hand, he'll execute a set of other real trades to benefit from the market price fluctuation that he has caused by spoofing. And those spoofed trades are basically fake trades that he's not going to execute. He's going to cancel them. So he's just increasing the volume of trades to send out a market signal that a particular stock is in high demand, causing the price of the stock to increase, benefiting from it, and then not executing the trades. And this is illegal, right? But this could be beneficial. Okay. So what happens is an algorithm doesn't know that what is lawful and what is not lawful. So when you just train the algorithms, it could actually pick up these kind of instances when breaches have happened and recommend those trades to you, right? A reinforcement learning algorithm could learn from that and recommend that activity. That's an unlawful and illegal activity. It's an act of market manipulation, right? So it's very important to establish the right regulatory frameworks for like an entity like SEBI. to inform all the market participants proactively as machine learning usage is increasing in trading activities, that here is a set of activities which are considered breaches. If you're training machine learning algorithms, make sure that you embed conditions within algorithms whereby the activities that are considered market manipulation do not get repeated by your algorithm, right? So I think that's very important. I do not believe adequate regulatory framework has been defined by SEBI at this time. So not much is being done on this front, but it's important to be proactive because the use of machine learning is picking up. The next thing is sort of the last thing I want to talk about is concentration and pro-cyclicality risks, and these are huge. And we see big market fluctuations because of this. So essentially what happens is when a large number of firms that are trading are using similar trading algorithms, which have learned from historical data, and historically, when a certain event has happened, the stock prices, for example, for a particular stock have crashed, right? So when that event is observed again, there'll be a large number of algorithms that are going to be triggering sell trades, right? Simply because they want to exit. The algorithm has learned from historical sort of data that when such an event happens, there could be a crash. So it's going to sort of execute a trade whereby it just wants to sell and exit. But if a large number of algorithms do that across a large number of firms, you're actually going to precipitate a crash, right? You're going to cause the crash to happen, even if it was not going to happen. So this is highly pro-cyclical in nature. This has been observed in real markets. So whenever you get to situations like you're getting close to hitting lower circuit, a large number of trades sell orders get triggered across sort of different trading entities, and it causes the crash to happen more quickly and exacerbates the impact of the crash. Right. So it's very, very important for appropriate governance frameworks to be developed, and for like again an entity like SEBI or the boards of the stock exchanges to define sort of proper criteria which should be put in place to prevent such concentration and pro-cyclicality risks. So I think with that, I'm going to close my presentation. This is all I had for today. If there are any questions, happy to answer them.
Thank you so much, Rachna, for explaining in such great technical detail the use cases and risks associated with ML in
My
capital
pleasure.
markets.
My pleasure.
It really helped understand things. Loved it. We're now going to be moving into a discussion space. And as we do so, I would like to encourage the viewers to bring us your questions so that Rachna can answer them for you. And we'll start.
Yeah.
I wanted to ask Rachna, is it possible to highlight which AI techniques are used for like trade strategies and trade executions?
Okay, so trading strategies, as I mentioned, what is used, historically, the simple linear regression, logistic regression, variations of the linear regression, decision trees were always being used. But what we are noticing increasingly is variations of neural networks, and also sort of more complex algorithms. So neural networks, yes, but also reinforcement learning algorithms that learn on historical time series data are being used to inform trading strategies. The more complex algorithms very often are not embedded within the trading algorithm, but are externally sort of used, and then the outcomes are used to inform the trading algorithms, right? But there's also embedding happening. When they do embed, there have been instances where some sort of not very good outcomes have been observed. So one of the largest banks in the world, which happens to be one of my clients, and I cannot disclose the name, was using deep reinforcement learning algorithm for FX trading, and they had to pull the plug on it because some trades got executed It was automated, so some trades got executed, which weren't very sort of lucrative trades, right? And so it, it, more complex algorithms are being used, but there's a learning curve, right? So there's going to be this process of some new discoveries are going to be made. There'll be some learning. They might step back and then they'll sort of correct themselves and move forward again. So I think that's fair. In terms of sort of trade execution, again, as I mentioned, the most complex usage that I've seen, trade execution is more about sort of, how these trades are executed, how staggering trades are executed. And again, here I'm seeing usage of reinforcement learning quite a bit. So in the NASDAQ exchange order, for which they've gotten a copyright and Securities and Exchange Commission approval from the United States SEC in September 2023, they're using reinforcement learning. And it's actually really, really interesting. It gives good outcomes. The benefits are in milliseconds because their trading orders were getting executed in such a way that it was static. The order would go in and wait for 10 milliseconds. And now it has become dynamic because of this reinforcement learning algorithm. So instead of 10 milliseconds, it could get executed in 2 milliseconds, which could sometimes give you better outcomes because in milliseconds, market prices can change.
That's very significant.
Yeah. So that's one of the first use cases of reinforcement learning I'm seeing in trade execution. The other use case I've seen is Royal Bank of Canada, and this I can talk about because it's public. They're market makers and they do principal trades for their large institutional clients. And they have a tie-up with KPMG, whereby a unit of KPMG is helping them develop algorithms so that they stagger their trades appropriately. And that's also using reinforcement learning. Staggering of trades so that the trades are lucrative and you don't cause the markets to crash.
Right. That's insightful. I wanted to ask you with regards to a couple of use cases for fund return forecasting, for portfolio weight optimization. Which algorithms outperform the others and why?
So again, the more it's increasingly appear portfolio weight optimization. The set of algorithms that are used are a little bit different. The use case that I had brought up was really clustering the assets into different groups using a very nice and intuitive unsupervised learning algorithm, and then determining what weights have to be assigned. So here there would be usage of the algorithm along with expert judgment. The asset classes that I was looking at it was very obvious what the clustering would be because there were commodities, there were bonds of different duration, and there were indices, and there were, assets where you could cluster. But you could apply an algorithm like this to an entire portfolio of equities and use fundamentals as well as returns, volatility, and liquidity data to classify the equity into different clusters. You could use this for identifying sort of value stocks vis-a-vis growth stocks, right? And then once a fund manager does that, they would assign weights based on what their fund objectives are, where there would be a little bit of expert judgment, right? But more complex algorithms can be used. The other use cases, again, neural networks, reinforcement learning, returns forecasting, neural networks are doing very well. But historically, decision trees have been used, variations of simpler models have been used.
Right. And like you said, multiple variations of neural networks themselves are applied to different, right? So we're going to transition to audience questions now.
Yes.
And we have some questions from the viewers. Ravi Kiran asked, using ML algorithms, can we identify which companies are going to be leaders in their field and which are going bankrupt?
Yeah, sure, you can. So this is again a very simple use case would be your unsupervised hierarchical clustering that I mentioned. You have fundamentals data. So you've got management, accounting data. You can calculate all the financial ratios, returns, profitability, value measures, intangibles. All of these are financial ratios, right? Which come from the balance sheets of these companies. And you use these for valuation purposes. But once you have these financial ratios, you could use a hierarchical clustering algorithm and cluster the companies into different groups and identify which ones are going to be leaders and laggers, in terms of returns. Yes, you can very much do.
Thank you for that. Ramanathan asks, are there backtesting systems where ML algorithms can be tested at scale?
Okay, this is something I have to admit that I have little experience with. So I can look it up and respond to the question later if that's an option that's available. But the kind of testing that I have done, I myself work in the model risk management function within the consulting business of a company. And we've actually, done sort of testing and validation of some of the algorithms that large banks and institutional clients were aiming to use. But that was more sort of really testing and validation. But the implementation environments for back testing, that's something that I have not gotten exposure to firsthand.
Sachin asks if SEBI has the ability to regulate the space currently.
I believe Indian, financial services regulators are actually doing a really good job, mostly. I'm not disillusioned with either the RBI or the SEBI. I believe that they have the ability. I mean, given the amount of technical talent that India has, even if they did not, I don't think SEBI at this time has in-house artificial intelligence experts, but they can call in a set of advisors anytime, and industry practitioners will be very happy to sit on a committee to give them advice on how to formulate these regulations. I believe SEBI has the competence, and I believe SEBI has the ability to identify where these algorithms can go wrong. I think the place where they could do a little better is being proactive rather than waiting for more crashes to happen. We've already seen situations where, they hit low, tickers hit lower circuit because of algorithmic trading very, very fast. So I think they should just be proactive and do the required.
Right. Ravi Kiran also asks if instead of training on live data and taking risks in data integrity, we can train on daily close data and identify the multipliers.
Yeah, sure. You can do like open, close, and average pricing is always, that data is always available. Yeah.
Right. So I think that's all for the viewer questions. Thank you so much, Rachna, for doing this. It was a very, very deeply technical and insightful talk, and it was great discussing these things with you. Thank you so much for taking the viewer questions. And I'm sure if other people want to reach out to you, they can.
Yeah, sure. Please, you can reach out. And I believe there was one question I could not take because I have not, the entire testing environment, I've not gotten exposure to. Because I've always worked as an external consultant and not within a bank, where they have big testing environments, especially because they're market makers. So I think that's something I could talk to a few expert colleagues and perhaps answer, but that's an area I've not gotten exposure to. But otherwise, I think this was great. It was fun. So thank you for having me.
And thank you so much for sharing so many areas of expertise that you did share with us. It was wonderful learning from you. Thank you so much.
Thank you.
With that,
thank you, Rachna.
close.
Thank you. Bye.